All right, we're going to talk about cost segregation. That can be a pretty heavy topic. So what I did was I put a white paper together, and I'm actually just going to read through it with you. Cost segregation allows us to accelerate depreciation, reducing tax exposure, increasing cash flow, all of which are exactly the strategies that we want to use as competent real estate investors. So this white paper that I put together will really walk you through this step by step. So what is cost segregation? I'm going to read it. So tax strategy allows real estate investors to utilize accelerated depreciation deductions to increase cash flow, reduce the federal and state income taxes that we pay on rental incomes. I didn't write the IRS tax code, but you know, the experts on our team know how to utilize it properly, legally to all of our benefits. So it's done by breaking down and reclassifying certain interior and exterior components. Think of it as the insides of the assets, the sinks, the faucets, the toilets, the fixtures, the lighting, et cetera, which are typically depreciated. The regular depreciation that we're familiar with is 27.5 years for commercial and residential properties. And then respectfully to personal property or land improvements, well, these are now allowed to be depreciated over either 5, 7, or 15 years, depending on which personal property class they fit into. This is all handled with what's known as a cost segregation study. And these studies for us are conducted by our qualified team of engineers and CPAs. It's intense. It's probably not something that the average investor would get themselves involved with. Cost segregation, as I said above, can reduce taxes and greatly increase cash flow. And this is due to the Tax Cuts and the Jobs Act. And as I said before, it allows depreciation of personal property, meaning, again, faucets, et cetera, over either 5, 7, or 15 years. And that's what makes it so powerful, because it accelerates the write-offs that we get as real estate investors. So I put a couple of examples together here. Regular depreciation, 27.5 years. Let's say investor Doe, that's John Doe, only I called him Investor Doe, who's in a 24% tax bracket, buys a 24-unit apartment complex. So they put $1 million for the acquisition. Now remember, it's only land, sticks and bricks that can be depreciated. It's not land. So there's a deduction for land value. But just to make it as simple as I could, I went through as follows. So in this example, they buy 24 units, $1 million, and all they do is utilize depreciation, not cost segregation. So what it looks like is this: the building's depreciated over that 27.5 years, allowing them to take almost $30,000 in annual depreciation, okay? So that's the 27.5 divided by, the 1 million divided by the 27.5 years gives you the 29,090 in depreciation. So in the example that we're using here, the investor will have to pay taxes on 90,000 that they got in income on it, but their tax liability is reduced by almost $7,000 in that 24% tax bracket. And this investor will still have the 29,090 in cash because they didn't have to put that capital out as an expense. Can we do better? Yeah. So watch. Cost segregation really is pouring gasoline on this IRS strategy. So let's say the investor, us, you, together, you know, we use our team for cost segregation, and we get the study performed. And the study finds that the value of the property is broken down as follows: 100% bonus depreciation on 5 years. So that's 5 years of write-off on fixtures and fittings, like we've discussed. The building is still depreciated on top of that 27.5 years. So using these calculations, it's an annual depreciation of 13,090 deduction on this. Well, that gives us a total depreciation in year one, cost segregated, $453,090. So what does that mean to us in a tax strategy in a 24%? It shows a net loss of $333,000 in year one, because we took it all in year one. That means we don't pay any taxes on the $120,000 of income, 28,800 tax savings at a 24% tax bracket, plus the remaining 333,090 we get to carry over into the following year for additional write-offs. So the additional cash flow can then be distributed directly to the fund, passed on to our investors. Alternatively, it could be retained for improvements in some of our other assets, or it can be used for a down payment. Now we've got capital that we're working with that we've created through these tax strategies to help with acquisitions of other units. You might have to watch this video a couple of times to really absorb all of that information, but the big picture takeaway is this, is that cost segregation feasibility study or studies are done by engineers and CPAs. That's part of our team. They work diligently for us when we bring these assets in so that we can maximize the strategies that are available to us. So cost segregation in alliance or in parallel with depreciation creates acceleration on the cash flow, right? And cash flow is king. That's why we do what we do. Okay, thanks, bye.